You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Chris Marchese, mining analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, Chris.
Great to be back, Jim.
Some important economic numbers released by the U.S. government on the gross domestic product, job creation, and some other numbers as well. Chris, how did the U.S. do when it came to creating jobs?
It missed consensus estimates as usual. This is private sector job creation. And as you know, most of us have gotten to know, public sector job creation usually doesn't miss because the government can just create them at will. And
whether they can afford them or not.
Yes, and that's only gross public job creation. We don't know how many were lost, as there is always some degree of that occurring, or how many were moved to only part-time or reduced hours, which has been a big problem. So the qualitative aspect is not taken into account.
I saw 218,000 jobs added to the U.S. workforce, but do they tell you what kind of jobs were created?
Exactly. I mean, my guess is a lot of part-time, as has been the case in recent past.
Sure, students getting summer jobs, mowing lawns, painting houses, stuff like that.
Exactly.
What about the GDP? How much did it grow, or did it?
Well, the headline came out at 4%, and there's no way that actually happened. I haven't gotten through looking through how it was all calculated, but I know that there are a few bloated numbers, including inventory build-up from Q1. That will be revised, among other things, lower in the second and final print of Q2 GDP. And I still think that it'll show a contraction by the final print.
Are they going to blame the weather again? I mean, the U.S. had its coldest winter in 30 years, and then apparently its hottest June ever. So if the numbers are revised down, is the weather going to be blamed again?
Oh, you know it. Or they might say something like, this summer was just too good. The weather was just too beautiful, or, you know, one of their usual gimmicks. But anyway, moving ahead on the economy, you know, we have to look at GNP, which we've discussed before, which includes trade accounts. So our trade deficit needs to be taken into account. And if you include that, then the economy only grew 2.7%. And that's a big change from 4%. And then again, we've gone through all the gimmicks the CPI includes, including but not subject to geometric weighting, hedonics, more prevalent substitutions, and so on. So
where they do things like take out the price of energy and housing, and when the price of steak gets too high, they substitute bologna, right?
Yeah, you know, and it's almost comical, and I think people are starting to get immune to this. The metals didn't budge, the stock market was down, and the Fed actually tapered another $10 billion, which I think they're going to have to reverse at some point, probably with a different policy. Because I think they did it in the first place because it's having diminishing margin and utility in terms of its impact on interest rates across the yield curve. So
no one ever heard of quantitative easing until the Fed made it up.
Yeah, and I don't know if we've discussed this, but it was never to try to kickstart economic growth, but it was always meant to keep the banks solvent. And the U.S. banking system alone has well over 400 trillion of derivatives on its balance sheet. So, and we don't know what the composition of those are. So, you know, we don't know the potential danger of, you know, changes in something like the 10-year, which, you know, the Fed can only control to a certain point in time.
Trying to explain derivatives to someone is trying to explain quantum physics to a 4-year-old. I mean, it's that complicated.
Yeah, I mean, I think the simplest way is to say that it's a product that derives its price from an underlying asset. Other than that, yes, it's rather complicated, especially because each derivative has its own unique characteristics.
Chris, what's happening on the metals market?
The metals are acting well considering, the head fake and the headline GDP. Silver's actually up a bit, and gold is only down a few dollars. Base metals all are up except for lead. So, this is kind of a non-event today.
It's interesting. Zinc has gone up in price substantially since you mentioned first, by the way. I never heard anybody else talk about it, about the 3 or 4 largest zinc-producing mines in the world shutting down in just a few years. But isn't lead associated with zinc? Don't you get them both at the same time?
Yes, and that's gone up quite a bit as well, not to the same degree. But yes, that's, you would have done very well if you had invested in, say, a lead ETF or a primary lead company.
I know the precious metals get all the attention. I mean, gold is bright and shiny and it looks great and people talk about it all the time. But these base metals, without them, our economic output on an industrial basis would fall apart.
Oh, definitely. But, it is smart to take profits from time to time. Like I've trimmed my zinc position a little bit just because they're so related to the world economy, whereas something like silver should do well regardless of how the economy is doing, because it's a safe haven but also has a significantly growing use in industry due to its conductivity properties.
Some of the analysts I've talked to are very nervous about October. They're expecting the Fed to say, that's it for quantitative easing. You're on your own now. And October's when traditionally we have a massive downturn in equity markets if there is going to be one.
Yeah, I would think and hope that they would do that. Although, there's economic data. It'll probably show its weakness well before that time. So we'll see whether the Fed keeps QE on to some degree or implements a different policy altogether. So it'll be an interesting time. Like we've discussed, throughout the year and last year, the policies aren't in place for a real recovery to take place, and until they are, which appears as if they will never be. Why would a recovery occur? And the same goes since 2009. So everyone's talking up this recovery. The market indices hopefully have topped, just because the higher they go, the harder they'll fall and more money people will lose. But at some point you got to face reality.
What kind of policies do you feel they need to enact to ensure a good recovery?
Well, they should let the market determine the interest rate, and because what the interest rate does, it's reflective of society's time preference. So a high interest rate is indicative of societies being more present-oriented and choosing to consume more rather than save and invest more, and vice versa. So low interest rates mean society would rather save and invest more rather than consume more. And we know that that's not the case, especially at these levels where the Fed funds rate is probably around negative 5% realistically, net of inflation. And even if that weren't the case and they were just at 0%, the demand for money or loanable funds would probably be pretty high, just because we know the economy isn't doing well, the labor market isn't doing well, and because of it's been almost 6 years since we've had any type of real interest rates, if those interest rates should rise, it'll show a lot of the misallocations of capital that have been made over this time period.
I know the whole idea behind low interest rates was for companies to get money at a very affordable cost and then expand their operations, hire more people, and boost the economy that way. But in reality, all that's happened is they've taken this cheap money and have just reacquired their own shares at a much higher price than what they sold them. As I explained to somebody, it's kind of like a snake eating its own tail. It is filling to start with, but in the long run, it's not a good idea.
And another thing is spending hasn't abated. The Congressional Budget Office expects the budget deficit to bottom next year in 2015, although I think it might bottom this year because tax receipts will come in lower than anticipated due to the recession gaining steam next year. But going out to 2024, it's supposed to increase each and every year, and that's according to a branch of the government, the CBO. So, and those have always proved conservative. So, it's the U.S. government has become so bureaucratic that cutting spending by any meaningful degree is, basically impossible.
I remember here in Canada, someone said when the CBC had this wave of layoffs, they're letting go 100 people, but then they hired 15 people to supervise them being let go. And those 15 people, of course, kept their jobs after everybody else was gone. The only people who don't lose their jobs in a recession are the accountants who tell you get rid of everybody else. But I've never seen an accountant recommend getting rid of accountants.
No.
Funny how that works.
Yeah.
Chris, thanks a lot for chatting with us.
Oh, my pleasure.
My guest has been Chris Marchese, mining analyst for the Morgan Report, which you can find online at silver-investor.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Comments can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.
Silver123.net is a silver saver program designed to be as simple as possible. For as little as $50 per month, you can set up and create an automatic cost average buying program that will get silver or gold sent to your door on a monthly basis. The first step to creating an account is easy. You will supply some basic information. Next, you will add a bank account from which you will schedule your purchases. Scheduling purchases makes saving easy. Silver Saver is customizable and allows you to control the amount and the date of purchase. Once you are signed up, you are then given your affiliate code. Now you can save in precious metals and also market this program. You can use email, web pages, and multiple forms of social media to share the Silver Saver program. Silver Saver will reward you generously with physical silver or gold whenever someone you refer becomes a saver. Silver Saver not only provides you with a share code, but also allows you to place your own banner ad on a website of your own. Silver Saver is one of the best ways to start saving and accumulating gold or silver, especially at these levels. Visit silver123.net and start saving today.